Hey everybody, hope everyone's doing well and had a good trading day. This is the Emini review for Monday, June 3rd, 2024. And because it's the first day of the month, we'll go ahead and look at the monthly chart first. And you can see the market is in a trading range. Big up, big down, big up. Now I've been saying this rally was strong enough that the first reversal will probably fail. Well, here's the first reversal. We went below a bull bar, found buyers, but now look at the past 3 bars. Even though it's comprised of trend bars, market has been sideways. The past 3 or 4 months have been overlapping each other, and that's trading range behavior. Plus, we had sellers into the close of May, which was disappointing. Bull breakout attempt, but high in a trading range, and the breakout bar could not close above the breakout points. Because of that, I'm expecting more disappointment for the bulls in the month of June. What the bulls want is follow through buying. So we had a bull breakout. They want another bull bar, closing well above the bars to the left. But I think more likely the bulls will be disappointed and will go more sideways to down. So for the weekly chart, today's Monday, and it's the start of the week. Similar, we're possibly high in a trading range, big up, big down, big up, confusion. And now last week was a high 1 signal bar. We traded below the low of 2 weeks ago, triggering a low 1, reversed up. Now we have a buy reversal bar, last week's bar, but 2 consecutive weeks without a bull body. This rally strong enough that it will probably get a second leg, but the second leg could be minor. And this being this strong really just means the first reversal will probably be minor and find buyers below. But that doesn't necessarily mean we're going to get a second leg that is symmetrical in size as the first leg here. Plus, this could be a second leg, leg 1, pullback, leg 2. I think if we trade above last week's high, we'll probably find more sellers above. And again, I think more likely we'll continue to go more sideways to down. And for the daily chart today, coming into the day, it's clear the market has been sideways. And more recently, we're in a tight trading range, lots of bars overlapping each other, bars closing in both directions. We had this surprising bear bar on the 23rd of May, which got a second leg down. So bear breakout, a little bit of a surprise, pullback, second leg. We found support around the May 7th high, this area, and we bounced. But now we have an outside bar from Friday. The problem with outside bars is that they're trading range bars. And so we have a trading range high and an overall trading range. So I thought more likely there would be sellers above Friday's high and the bulls would be disappointed, because outside bars being trading ranges, do you really want to buy high in a trading range? It's sort of a nested pattern. This being an outside bar, failed breakout below, breakout attempt up, but the bulls need follow through. So this is high in this trading range and it's high in the overall trading range. So I thought more likely it'd be a disappointing bar for the bulls. Coming into the day, we had that really strong rally at the end of the day and end of the month for the end of May. Then we had a gap up for bar 1. Bar 1's a bear bar, and it's basically a trend bar. Small tails, bigger body, but relatively small bar. Gap up, so it's possible that the bulls get a second leg up, but this was so climactic, and then we had a pause and a second leg, that the market may be entering a trading range here. And you had bears selling above bar 81, selling above bar 80. They're trapped on the gap up, but if this is a trading range, they'll probably test the gaps and be able to avoid a loss. And then bar 2, bull reversal bar, but small, and it's a high 1. but possibly high in a trading range. And I say high in a trading range, it's less obvious on this chart. There's a lot of empty space to the left. But if you keep in mind the daily chart context, you'll remember we're high in a trading range. We're getting climactic buying. So high one, but the context isn't great. The signal bar is small, and it's following a bigger bear bar, so there might be more sellers above. Now bar one remains the high or the low of the day, about 20% of the time in general. So the odds are we'll go above bar one, so there may not be sellers until we get above bar one. And then you can see bar three. Looks like we tested the high of bar one. Maybe we want to tick below 1325, 1325. So it's a perfect double top with bar one, and there were sellers above. But the first three bars are overlapping each other. And the first few bars of the day will usually give an indication of what the day is going to look like. And what do we have so far today? We have 3 overlapping bars. So the most likely type of day is going to be some sort of trading range day. Bar 3 micro double top, possibly in a trading range since bar 80 or 79. With magnets below, we may have to test lower. Now we have a second entry short. There was a short below bar 1 that triggered, and now a second stop order short below bar 3. I think bulls will exit below bar 3, and some bears will short below bar 3, betting that it could be the start of a swing down. Inside bar 4. So the bulls were able to prevent the stop order from triggering below bar 3. But with bar 4, if you're a bull, what are you thinking with the first 4 bars of the day? Even if you're a bull and you're hoping this is a really strong rally, them gapped up or continuing higher, the first 4 bars of the day are disappointing. They're just sideways and small bars, all overlapping each other. And we're far above the moving average price down here. If traders are going to buy this much of a premium, this far above the moving average, they want far above average bullishness, and this is not far above average bullishness. We've had one bull bar, really, bar 2, and it was a doji. And then bar 4 closed with the bull body, but closed well below its midpoint. It's a reversal bar. So do you really think bulls want to buy this far above the average price? Probably not. So we may have to go more sideways to down before traders are willing to buy again. And then you can see bear breakout, bar 5. Traders not happy with the first 4 bars of the day, I should say bulls, and we have a micro double top, bar 1 and bar 3. Now we're triggering the short below bar 3 or bar 4 on bar 5, and bar 5 is a strong breakout bar. But it's testing the high of bar 80, where bears may have gotten trapped. They may look to take profits here, so they may bounce here. Bar 5 is strong enough that it'll probably get its own second leg. At this point, we have a bear breakout, and the bears want follow through. And then look at bar 6. We tested lower to the bar 81 high. We tested the close of the prior bar Friday, and then we bounced. We found buyers. So it looks like the market's in a trading range. Big up, big down, big up. First 4 bars overlapping each other, and then a bear breakout with terrible follow through. Now the market went far on bar 6. So 5 and 6, we went all the way down here. So I still think this could simply be a pullback before we get a second leg down. Bar 6, the problem with buying bar 6, we have a 4 bar micro channel since bar 3, and then bar 6 has a bigger tail than a body, and the risk is big. And so if you're buying, and let's say you're buying above bar 6, if you're going for 1-to-1, you know your equation is bad. Your trader's equation is bad. Stop below 6, you buy above 6. Your target's all the way up here. And like I just said, this was strong enough down. It'll probably get a second leg. So it's not clear we're going all the way up here before back down here. It's forcing you to buy possibly in the middle of a trading range when the probability favors lower prices. And then 7, we rallied on bar 7, close to maybe the 1-to-1, but then reversed down. At this point, we have big up, big down, big up, big down, clearly in a trading range, but still far above the average price. And so that's a warning. Even though all the bars are above the moving average, bulls probably don't want to buy until we're closer to the moving average, the average price, a more fair price. And we get there in two ways. We can go sideways or we can go down. Because every bar that gets added to the chart gets included with the past 20 bars, the exponential moving average. So even if we go sideways for the next 10 bars, the moving average will continue to rise. Bar 7, same problem as bar 6. If you're selling, it's a big bar, so big risk. And it's been a trading range all day. And so it's not clear we're going all the way down here before back up here. It's a low one short with a big signal bar and possibly low in a trading range. But the market's looking for direction. We gapped up above yesterday's high and found sellers, not once, not twice, but 3 times. So we're above, draw a horizontal line. Here's the high of yesterday. Market gapped up above and it rejected it on bar 1. We tried going up again on bar 3, rejected it, and broke back into the range of Friday. And then we tried to break out again, and then it reversed down on the same bar. So at this point, it does not look like the high of yesterday or the high of Friday is support. It looks more like resistance. Plus, the average daily range has been about maybe 40 points. And right now we have a daily range of about half that. So I think at a minimum, this opening range will double and we'll get a measured move either up or down. And at this point, I think it's more likely we get a measured move down for the reasons I just said. So we can come all the way down here before we get a measured move all the way up here. Bar 8, another bear bar. Not quite an inside bar. We triggered the stop orders below 7, but didn't really go anywhere. So more overlap. Obviously, the market's very two-sided, but if you look at, like I mentioned earlier, now the bulls have 2 bars. They have bar 2 and they have bar 6, but both times the bars have small bodies and big tails. For the bears, almost all the bear bars are closing near their low, so that's pretty good selling pressure. Plus, the bears own many more bars than the bulls own today. And so these are subtle but important clues that we may go lower. Bar 9 triggered below bar 8, and then we got a strong bull bar. It's a trend bar, but the context is bad. It's in the middle of a tight trading range. Now, this sell-off from the high of bar 7 to the low of bar 9, that was strong enough for its own second leg. So bar 9 could be a vacuum test of resistance, maybe testing about 50%. And that's this red line. That's about the high of bar 9. So we're vacuuming up, and it's a good-looking bar, but the bulls need follow-through. The bulls will argue it's a double bottom, bar 6 and bar 9. You can call it a triangle, 3 pushes down, 1, 2, 3. Maybe some sort of triangle or wedge, and a good signal bar 9. But again, the context is really not good for the bulls. The bulls need to do more to convince traders that this is a strong breakout and that we're going higher. Follow through, bar 10, but still in the middle of a trading range. It's a small bull bar with tails. Now it is follow through for the bulls, and that's good. Increases the chances that the bulls will get a second leg. But the only problem is that on a smaller time frame, the rally from the low of bar 6 to the high of bar 7 was more clearly a series of bull bars, maybe in a channel because their tails on this time frame, so they were minor. But the point is, market rallied from the low of 6 to the high of 7. That's a fairly big distance, and so this could be a pullback, and now 9 and 10 could be the second leg from that rally. And then bar 11, we have a bear bar. You can call it a high 1. It's an outside bar. It's an outside bar in the middle of a trading range. Bear body and just below yesterday's high, Friday's high. Probably more sellers above. And then inside bar 12. Bar 12 is the end of the 60-minute bar. And if you can imagine the 60-minute chart, here's the open, here's the close. So we have a bear body with a small tail above, really opened near its high, and then a tail below. So the bears own the bar, but the bulls put a pretty big tail on it. And so the bears can say, we own the 60-minute chart, but the bulls say it was a weak bar. But still, the problem for the bulls here, when you just look at the first 12 bars of the day, you can even include a couple bars from Friday, the market's totally sideways, and we're still above the average price. You can see the average price is climbing closer to the price, the current price. We've gone from way down here to up here. So we're getting closer to the moving average. But when you look at this chart, is it bullish? Of course not. It's really sideways. You could argue really strong bull breakout, possible bull flag. The trading range is less than 20 bars. And Al says, as long as the trading range is less than 20 bars, he'll consider it a flag and not a trading range, and that's fair. So we're less than 20 bars into a trading range. But pay attention to what keeps happening at Friday's high. We rejected the gap up. We keep reversing down from Friday's high rather than breaking strongly above it and finding support. 12 is an inside bar, and just below that resistance, probably more sellers above. 13, bear breakout, breaking below the past 3 bars, but still within the trading range. So we're now low in the trading range. But again, overall structure for the day, it looks like we are rejecting the prices above Friday's high. The market may have to go lower to find buyers. Now the buyers may come in at the moving average. There's been over 10 bars completely above the moving average. That's good for the bulls. But again, the types of bars we've had, the bears have controlled many more bars than the bulls. And the price action has been average. It's been sideways in a trading range. Also, it looks like a strong bull trend, the rally into Friday's close, and it was. But now we're getting a possible triangle, and triangles are often final flags. What are final flags? It's the last flag in a trend. So we have a bull trend, possible final flag. Even if we get a bull breakout, it could easily reverse. 50% of breakouts of triangles are the wrong direction, and they reverse and go the other way. But I think more likely, you could argue it's 50-50. You could even argue it's more bullish because we've been sideways for less than 20 bars. But I think considering the context, we'll probably have to go lower to find buyers. 14, we're getting the breakout of the triangle. So good for the bears, but the breakout is not all that strong. Both bars overlap all the bars to the left. So bar 14 is really the only breakout bar, breaking below bar 6, the low of the day, and then look what happened at the moving average. It's bouncing. What would be more ideal is if the market broke strongly below the moving average and didn't stall there. But the bears have a 4-bar micro channel. Bulls might argue leg 1, pullback, leg 2. You could even say leg 1, deep pullback, leg 2, pullback, leg 3. Whenever you have a double bottom and then a breakout below the double bottom and then that fails and reverses up, it's considered a wedge. So the bulls are hoping bar 15 is a disappointing bar for the bears. And then they have a wedge bottom at the moving average, possible wedge bull flag. Even if it's a final flag, there might be more room to the upside. The bears hoping, bulls are trapped, buying below bar 12, buying anywhere up here, and now there's 4 bars against them. So any pullback, probably sellers above bar 14. 15, the bears got minimum follow through, but it's an inside bar and it's still not breaking below the moving average, so not ideal. But do you really want to buy above bar 15 as a bull? Probably not. It's a 5-bar micro channel, weak signal bar, it's a bear bar with not much buying pressure. And then 16, we're getting the downside breakout. Now the market, I mentioned earlier, the opening range was less than 20 points, the average daily range has been about 40 points. So it's easily possible that the opening range doubles, and this could be the target for the bears. So here's the opening range, measured move. And then 16 is a strong bar. Now bar 16, there's two options for what you could call bar 16. It's either a measuring gap or an exhaustion gap. So does 16 look like a climactic end of a trend, or is it possibly a measuring gap, which could be the middle of a trend? And that's what the opening range measured move is, from the start of the bear leg to this breakout point. You could even say it's bar 15. So this could be the measuring gap measured move down here. Either way, there's magnets below, and the market is clearly always in short. I think especially on the close of 16, it may not have been as clear in here with sideways bars and the rally, the gap up. But now, I think it's more clearly always in short. Solid close 16, but we've had a 6-bar micro channel. The market could pull back before we get more selling. And then instead we got a follow through bar 17. Still sell the close, always in short. The bears now have a bear trend bar completely below the moving average. So 16 crossed the moving average, closed well below, and then 17 follow through bar. So that's good for the bears. Probably going at least a little lower. Another measured move the bears might be looking at is of this breakout, 16 and 17. That brings you close to the 60-minute moving average. And what do you do here? If anything, you sell. So you're either short or you're flat. But I don't think you can be buying here. Bulls will argue it's 3 pushes down, 1, 6, and 17. But it's so steep, the channel down is so tight that your only options are short or flat. 18, it's a profit-taking bar. We went sideways, but bar 18, can you buy above 18? No. Bar 18 is a minor reversal. Still micro channel since bar 11, and it's a strong breakout since bar 11 or 12, with many consecutive bear bars, many of them closing near the low, crossing below the moving average, and anybody who bought below bar 6, betting it was the low of a trading range, they're trapped, and we did not get back to that price. So bulls, we have a gap from the low of 6 to the current price, the high of bar 18, and if we don't rally and get those bulls who are trapped, if we don't relieve those traders, they will provide fuel to the selling to the downside. So 18, if anything, it's a minor reversal. Traders will sell above it. 19, another bear bar, so the micro channel continues. And there was some buying below 18, but still a minor reversal, and 19 closed near its low. So again, the only options here are short or flat. Some bears will look to take profits, maybe expecting a pullback, but again, this is so tight, it's really easier to swing at least part of your position and go for some sort of measured move down. Remember, this red line is the measuring gap, measured move, and so traders will see how the market behaves if and when we get there. And then an outside bar 20. 20, as strong as bar 20 is, it's still a minor reversal, still a really tight bear channel, and 20 did not significantly break the bear trend line. We may go higher. 20 was a strong enough bar that may get a second leg, but it's a minor reversal, so if anything, there's probably more sellers above 20. And then 21 was disappointing, so we triggered the buy above 20, but found sellers above. 21 tested the low of bar 16. There was a gap, and anyone who bought below 16 was relieved if they were quick enough, and if they scaled in, they could have made a profit, but really hard to do. At this point, the bulls are not really making money. Even limit order bulls are having a hard time making money. And what does Al say? He does not want to be the first trader to make money, or in other words, the first bull. In this case, the first bull to make money. It's much easier to make money if you're shorting. We're always in short. It's easier to trade in the always in direction. Again, 20 was strong enough that it could get a second leg. So now 21, it's a low one, sell signal bar. Might be more buyers below, and the pullback could get deeper. Maybe we test the moving average. But I would not buy even for a scalp. I think too dangerous, too much risk of a downside breakout when the market is this tight down. And then 22, we did not trigger the low one below 21. Instead, 22, we went higher. But now we have bull bar 20, pause bar 21, and then a bull bar 22. That could be your second leg for a bull, and some traders will even call it 3 pushes up and a wedge bear flag, so up on 18. Market often, like, you may argue that how could we include 18 in this pullback if we went to new lows? Well, it's a common occurrence. If you look closely, you'll see it happen really fairly often. So here's our first push, 18. We went to a new low, and then 20, pause bar, 22, 3 pushes up, and a strong bear breakout. Probably going to find more resistance above and sellers above bar 20. And then 22, we tested the moving average, and the bar closed near its low. It's only a doji, but if anything, if you're a bear and if you exited shorts anywhere for any reason, I think you got a short again below 23. And if you're a bull, I would exit longs below bar 23. It's a low 3 at the moving average in a bear trend. 24 triggered the stop order sell. Now 23 was just a doji, which is a trading range, so selling below trading range bar is not ideal. Plus the bar is small, so small risk, good reward, bigger reward, and low probability. So there's an increased risk. We trade above bar 23. So if you did sell below 23, does the stop go above 23? No, I think at a minimum, the stop goes above bar 16, if not the start of the channel, or the spike down, the bear leg down, which would be bar 11. But now 24 is a high one, and it's consecutive dojis. It's maybe 3 or 4 pushes up for the bulls after a tight bear channel below the moving average. Probably more sellers above 24, and maybe even sellers on the close of 24. And then you can see we went outside down 25. The high one triggered, and bears were scalping above 24. And if a bull did buy anywhere, they exited their longs. 25, if you're still long, you got to get out below 25. A bear bar closing on its low, it's always in short. So if you're long, exit longs. And if you're short, if you got out of shorts for any reason, okay to enter short again below 25. Now we have a bear flag from bar 20 to 23. So traders will look at this measured move as a possible target. Outside bar 26. So remember what I said. If you sold 23 and then you get 25, things look pretty good, but your bar was still small. Your signal bar is small, your risk was small. It's really a skunk stop. That's what Al would refer to as a skunk stop. The stop at a minimum goes above 16. And so if you had a stop above 23, 26 would run your stop and you'd be trapped out. Now it looks like the market is more sideways here for the past maybe 8 bars. But there's really nothing to buy. The bulls are hoping we had this tight channel, trendline break, and then maybe a double bottom, major trend reversal. But this was still a minor reversal, and the bulls could not even get consecutive bull bars. And so that's not very strong. Now, there might be more buyers below 26, and we may be in a trading range here, but it's still less than 20 bars sideways. And so we may have more likely a bear flag than a trading range. So I think more likely we're going to break out to the downside. The bulls are also doing a good job keeping the price below. The bears are doing a good job keeping the price below the moving average. 27, there were buyers below 26, and now we have a buy signal, 27. You can call it a high or low double bottom, but the pattern is small. It's made up of about 8 or 10 bars, and this was so strong. I'm not sure if this was enough of a trendline break to disappoint the bears. Now, it might have been, but you also have to dissect the buying pressure in this area. Like I said, the bulls couldn't get consecutive bull bars, and this bull bar was weak, obviously closing well below its midpoint. And then the signal bar 27 is a trading range bar and below the moving average. So there might be more sellers above if this is a trading range. This bar is high in the trading range. You can call it a high 2. Every double bottom is a high 2. But high 2s are good to buy at the bottom of trading ranges and in bull trends. And 27 is neither of those. So there's probably sellers above. Inside bar 28. Another high 2. We just went sideways, but now the signal bar got worse for the bulls. Probably sellers above, going more sideways to down. And we triggered the high 2 on 29. So now the past 5 bars have completely overlapped. We're below the moving average, and like I said earlier, for the bull case, this is the opposite. The market might be in a triangle, and triangles are often final flags. So the bulls are hoping this is a final bear flag, so even if we get a bear breakout, it'll quickly fail and reverse up. The bears just simply see this as a bear flag, and they're still looking for a measured move down. What's the measured move targets? Well, here's the measuring gap. You can take a measured move of 16 and 17. It brings you down here. You can take a measured move of the triangle. That takes you down here. So several magnets below. And you'll notice I'm not talking about magnets above. And that's really, maybe I should, because it is breakout mode, a possible final flag. So 29, possibly a bull breakout above 29. Maybe we get up here. But the problem is, even if we do get up here, look what happened the last time we were here. We had a strong bear breakout where bulls got trapped. So even if the bulls do rally up to here, more likely the market's in a trading range. And there will be disappointed bulls who bought here, scaled in lower, looking to exit. Now, like I said, we have open gaps. The most recent gap is any bull who bought below 14 or 15, betting it's a trading range, maybe 3 pushes down at the moving average, they're trapped. Below 15 never got retested. So we have trapped bulls in the market who are desperately trying to scale it lower and avoid a loss. What's interesting about that too is if you're a bull and you bought the low 15 and then you bought above a bull bar closing near its high, bar 20, your average price is this middle red line. And look where bar 26 tested. Came very close to that line. Found sellers. So the bulls are desperately just trying to avoid a loss, and they don't even care if they can make a profit anymore. The point is they're trapped, and if they're sufficiently disappointed and they get squeezed out, those bulls are providing fuel for the next breakout down. And then 30, we're in the apex of a triangle, and we have a bad buy signal bar 30. It's a bear close below the moving average. Probably sellers above. Outside bar 31. I say outside bars are trading range bars, and they are, and this is occurring in a trading range. And the problem with buying below here is the context. I think more likely we'll find lower prices and get the bear breakout. And as far as selling above, I think that's fine. But buying below, this context does not really support that. And then if you did buy below, look at your entry bar 32. You're disappointed. So if you did buy below 31, that's your entry bar, you might just give up on the trade. And 32 is a bad stop order buy above, so probably sellers above. And then you can see everyone gave up on 33. When I say everyone gave up, what I mean is, a couple of things. I was talking about the trapped bulls below 15, never getting a chance to exit, and they got squeezed out here. And it looks like this is 33 is a give up bar. And then a more minor pattern, if a bull bought below 31, betting it's an outside bar in a trading range, that's their entry bar. They're just going to bail out of the trade. And that's what happened on 33. Now, 33 is another breakout bar. And I erased the drawings, but we may be racing to this measured move. No one knows exactly where we're heading, but the point is we're going lower. And remember I said triangles are possible final flags, and at this point we now have 1, 2, 3 sell climaxes. And so now we had a tight bear channel, possible final flag, this triangle, maybe enough of a trend line break that the problem here, what the bulls are looking for is a lower low, major trend reversal, but this was so strong it'll probably get its own second leg at a minimum. And then 34, follow through selling for the bears, so that's good. We have another open gap from the low of 20 to the current price, or the high of bar 34. So from the low of 20 to the high of 34, there's a gap. Any bull who bought is currently trapped. But why is 34 such a small bar? If 33 is a strong bear breakout and we're going lower, it's suspicious that bar 34 almost completely overlaps bar 33. Now it is good for the bears that it's a bear breakout. It's a big bear breakout, and it had a follow-through bar. But when you look to the left, also keep in mind, we had this buy the close rally with really strong bull bars, and now we're getting 1, 2, 3 pushes down, 3 sell climaxes. It'd be really unusual. Well, let me back up. The sell climaxes for the bears really isn't great. And I want to explain that because I remember hearing Brad talk about that, and I was confused by it. I didn't understand why. Why is this bad for the bears? Why are these breakouts bad? Well, one of the problems is that the bears are becoming exhausted. The bears who are selling anywhere are getting a windfall of profits with these breakouts. So it's a strong breakout with consecutive bear bars and going a far distance. But the bars are not uniform in size, and when we do get selling, we then go sideways. We get selling, we go sideways for a lot of bars. We get selling, what are you expecting? Now it's possible 33 and 34 is a spike in channel, leads to lower prices. But so far what's been happening today is we've had sell climaxes resulting in sideways to up. And so it's possible we do the same after 33 and 34. But the problem with this one is that it's the third one. So 1, 2, 3. It's hard to, well, let me back up. Leg 3, you really don't want to trade leg 3. If anything, you want to fade leg 3. So what that means is you get a bear breakout, you're expecting a second leg. This could have already been a second leg. Leg 1, pull back leg 2. The reality is this was strong enough to reset the count, but then here's your second leg, and now you can draw 3 pushes down, possible wedge after such a strong rally. You know the market is in a trading range and not a strong bear trend. And it's also clearly a bear channel. And bear channels you can think of as bull flags. 25% chance you get the bear breakout and accelerate into a stronger trend, and 75% chance you get the bull breakout. So that's the problem with selling down here on 33 and 34, at least for me. 35, trying to break out of the channel line. It's a micro channel since 31. The odds are we're going to get a second leg down. But we're getting parabolic. We're going far from the moving average rather than, I don't know if this might be a good example. Look at the bulls here. Strong breakout and then control above the moving average. Price is almost parallel and there's not a crazy steep slope. Obviously it became parabolic here. But up until here is what I'm talking about. And that's controlled. You can say the same here, and then it got parabolic. And then when it got parabolic and increased, we went sideways to up. So what might be happening here on 35? We're accelerating down, and this is not controlled by the bears. That's the problem with sell climaxes. The bears are making profits, but they're going to take quick profits because it could have exhausted bears, 3 pushes down. Eventually you're going to run out of sellers. You have strong bears who sold up here taking profits, and you have strong bulls who are looking to buy down here. 36, a doji it depends how you draw the channel line. We know it exists, and so we're near that channel line. It's becoming parabolic, 3 pushes down. 36, inside bar, and so that's a small triangle on a smaller time frame and possible final flag. Now this is really minor, so it's maybe too early to say that. But the point is, we're getting far from the moving average. After 3 pushes down, we may have to go more sideways to up before bears look to sell again. And strong bulls, we're getting close to the start of this strong breakout, which didn't get a second leg. And it's very likely a strong breakout like this will get a second leg. So bulls look at this as a strong breakout, a wedge bull flag, high or low double bottom with 75, and they're looking to buy, but of course there's nothing to buy yet. Outside bar 37, outside bars are triangles, and it's extreme for the bears here, trying to break out of a channel line near support. If anything, probably more buyers below 37, but really hard to do when you've had almost maybe, 7, 8, 9, 10 consecutive bear bars. And then look what happened on bar 38. We could not trade below 37. The bulls were so eager to buy below that they didn't even get triggered. And then there was a sense of urgency. Traders had to start pulling their limit orders higher and maybe buying the market on 38. And we got a strong bull bar. Bar 38 is still a minor reversal. So this probably is not the bottom, and we're going to go straight up. But it's enough of a strong bar after 3 big pushes down, far below the moving average. If anything, if I was short, I would get out of shorts above 38. And it's really aggressive, but some bulls might buy, betting that it's the start of a swing, but low probability. 39, triggered the buy and then reversed down. 39 is a low one, but bad context, probably buyers below, but they may not come in until below 38. 40, we have an overlapping bar. It's technically a sell reversal bar, even though it has a bull body, closed below its midpoint. So going more sideways. This was strong enough for a second leg, bar 38, so we rallied, pulled back. 40 could be that second leg. But as far as selling below 40, same problem as 39. Low one, but bad context, and after a strong bull bar, probably buyers below. And then 41 sold off to a new low. You can see the buyers came in below bar 38. Now we have a micro double bottom. 41 is not a very strong bull or buy signal bar, but it is a second reversal up. We reversed above 38, pulled back, and we're reversing back up again above, possibly above 41. If you're not already out of shorts, I'd get out of shorts above 41. In general, this is a bad stop order trade above 41. It's basically a doji, has a bear close, and it's a tight trading range, but possible final flag. Like I said, 1, 2, 3 pushes down, possible final flag here. This might have been a final flag, so the last flag before the last breakout and then a reversal up. We're at bar 41, so we're about halfway through the day. Bulls are thinking about a midday reversal with a double bottom with 75. Like I said, rally, maybe complex pullback, and then a big second leg for the second half of the day. 41 had sellers above on 42, but 42 is a small bar and in the middle of a trading range. A tight trading range since maybe 35 or 36. So selling below 42, forcing you to sell below a small bar in the middle of a tight trading range. That's low probability, probably buyers below. 43, another bear bar, but still not breaking out. We're still within this trading range. So now we're getting low in the range. And it's big down, big up, big down, big confusion. Far below the moving average. Bears, they don't want to sell until we get closer to the moving average because the momentum has really dried up. We've gone more sideways here, so probably buyers below. Outside down, 44, but remember what I say about outside bars. They're trading range bars, and this is a trading range bar low in a trading range, so probably buyers below. 45 broke out to the downside. Now we have a nested wedge. 1, 2, 3 pushes down, 6, 20, maybe 37. And now we have 1, 2, 3. 37, 41, 45. A bad signal bar, 45. And not quite a micro channel, but obviously a lot of bear bars, so hard to buy above 45. But as far as selling, I would not sell above 45 because it's more sideways and possibly late in a bear trend and far below the moving average. And then a bull bar, 46. If you're short, I would get out of shorts above 46, and bulls will buy above 46, betting that it's early in the swing and possibly a midday reversal. So what I was saying earlier, I don't remember when I said this, but I was going to say it has to do with the consecutive sell climaxes and the fact that we're getting sell climaxes and then sideways, sell climax, sideways. It's just so unlikely that this behavior continues all day long. And we've had about 66 points down. And so that fulfills the average daily range measurement. So is it more likely we continue and get a 120 point day that just continues doing the same thing, sell climaxes, pulling back, sell climaxes? Of course not. Now that doesn't mean it's likely, at least not yet, that we get a rally that will undo all of this selling. But one thing to know is that these sell climaxes, as far as the bears went, they covered about 65 points. It's not as strong as it could have been. So above 46. Bulls will buy, hoping it's the start of a swing. And bears, strong bears who sold up here, they'll get out of shorts above 45 or 46, even 38. And then follow through, 47. Not the strongest follow through. And now bears will argue, been in a trading range for less than 20 bars. We're high in the range. Strong enough bull breakout, it'll probably get a second leg. So bears won't short below 47, but they'll look to short a second entry. Bulls, they might buy below 47, but the context isn't great, possibly high in a trading range or bear flag. But 2 consecutive bull bars, 46 being strong, and a big distance from the low 45 to the high of 47. You know the odds are we'll get a second leg up. And 48, continuing to break higher. So we did not trade below 47, and instead the breakout is growing. So now we have bull breakout. You could say it started at 45. This is the start of the micro channel. You could say it started at 46. Either way, we have a couple of bull bars that are pretty big, closing on their highs, and now 48 is closing above the moving averages. The bulls still want more follow through here to convince more and more traders that this is in fact a strong bull breakout and not just a buy vacuum test of resistance to the left. And then more follow through, 49. So at this point, probably buy the close, probably always in long. As soon as the market becomes always in long, it's important to look to get into the market in the direction of the always in. And so you can do that by buying the close of 49. At this point, we have a micro channel since 45. So traders are hoping for a pullback and they're not getting it. So there's a sense of urgency. And you know this is strong enough that the first pullback will be minor. So even if you bought the high tick of 49, the odds are you'll be able to, if anything, worst case, scale in and avoid a loss. Another bull bar, 50. This is a pretty good bull breakout with consecutive bars that are not climactic, and any bear who sold above 45 or even sold above the high of this trading range, 39, they got trapped on 48 and further trapped on these bars. If you sold above 34, you're also trapped there. So the bulls are creating gaps, and now the bears are trapped, and those trapped bears, if they don't have a chance to get relieved, will provide fuel for the second leg up. Bulls and bears are trapped. Bulls weren't really expecting this. There wasn't much of a major trend reversal set up here, so bulls weren't buying above 45. Maybe they started buying above 48 or 49, but the point is, you have trapped bears selling above bars. You have trapped bulls who didn't buy, and both are looking for a pullback. The bulls looking for a pullback to enter long. The bears looking for a pullback to enter their losing shorts at a lower price. 51 continuing higher. So the micro channel is continuing. If you're a bull on the sidelines waiting for a pullback, that's the importance of entering once it's always in long. And then a doji 52. So the momentum is slowing down. Probably pull back here, but probably a minor reversal. Buyers below 52. 53, the first bear bar since really 44. 45 is technically a bull bar. And the bulls just put 5 consecutive bars completely above the moving averages. And the odds are traders will buy the first bear bar like 53, and it'll be a minor reversal, and this will get a second leg up. Now the bigger context, remember what I said, strong rally here, and then sell climax is down. We could get all the way back up here. And this was strong enough that you know we're going at least a little higher. And bulls are looking at measured move projections. Maybe a measured move of this breakout somewhere up here. And lo and behold, it's where bulls got trapped, buying below bars over here. 54, so the first bear bar, traders bought below it, but now 54 is a high one after a strong rally. Probably we're going higher. 54 is not an ideal signal bar, but I do think traders will buy above 54, stop below 46. And then you can see we had a tick gap. The close of 54 is one tick below the open of 55. And that's a sign of urgency. That's a sign of traders. As soon as 54 closed, traders hit buy the market, by the close of 54, and we gapped up. 55 bull bar. Bears hoping it's a double top, but it's minor even if they get a good signal bar. Odds are we're going higher after this breakout. And then 56, there's your double top for the bears, but it's a higher high and a doji, probably buyers below. 57, a little bit of a surprise, but possibly 2 legs, 1 pullback 2. 57 is strong enough, it might get its own second leg, but it's also possibly a second leg trap. And some traders, you can see it as an expanding triangle. And so with 57, you might have more buyers below. And then 58 disappointed the bears. 57 was a sell vacuum test of support. The bears tried to break below the moving average. They got 1 close, but the majority of the bar is above the moving average. And then bulls bought the close of 57. 58, it's an inside bar, and I usually say with inside bars that the probability of a breakout is reduced, which it is. It's a trading range on a smaller time frame. But I think there's buyers below 58. And as far as selling above, I would not, because I think this is a minor reversal and more likely a bull flag, and higher prices are likely. 59, bull, a good entry bar for the bulls if they bought above 58. It's another bull trend bar. And at this point, the bears again are hoping we create a double top with 56, maybe head and shoulders, left shoulder, head, right shoulder, but the momentum from 58 and 59 is strong enough that it'll probably get a second leg. And it could be the start of a bigger second leg. So this might have been 1, pullback 2, and then here's leg 1, complex pullback, maybe leg 2. 60, we went outside down. So bear bar closing on its low, and you can call it a wedge, 3 pushes up, 51, 56, and 60. But it's still minor. Now there's enough of a trend line break here. The bears are hoping that if you sell below 60, it's a major trend reversal. We come all the way back down and close the gap with 45. But this breakout was so strong, the odds are there's still buyers below, even if we go below 57 and 58. 60 could be a, maybe 50% pullback of 58 and 59. So bull breakout here, pulled back almost 70%, and might be low in this range, the bull flag. So it might be more buyers below 60. It's also completely above the moving average. And then another inside bar, 61, similar to 58. I would not sell above. You can buy below, you can buy above, hoping that the breakout is a breakout of a bull flag and that the bull trend continues. And then a decent entry bar, 62, didn't go far, but closed on its high. So as far as selling above, most traders will not. 63, bull breakout, which pulled back and closed within the breakout point. The bears still arguing 3 pushes up. The bulls not getting the breakout of the channel. But there's also not as much selling pressure as the bears would like. The bulls control many more bars in here than the bears. Now 63, fairly big bar, so big risk, and a trading range bar, so weak signal bar, probably buyers below, probably getting a second leg up at a minimum. And I'm referring to these bars, and we also need a second leg from this. So leg 1, pullback, and probably going higher for leg 2. And as far as magnets, I'll draw it on the 15 low. There's an open gap from the 15 low. Market already closed the gap here. If a bull bought below 20, as crazy as it sounds, scaled down lower, they were able to avoid a loss and make a profit on their scale in entry. So the market obviously went sideways once we got here, but it looks more like we're going sideways and staying above it than bouncing at it and becoming resistance. This is the line I'm talking about. So the market's continuously trying to break out, and now we're above it on 63. And then 64, going a little bit higher. Inside bar, probably buyers below, and dangerous to sell above. Fairly tight bull channel since 58, with really just one bear bar in the past 6 or 7 bars. And then 64, bull bar closing on its high, reduces the number of traders selling above. And then instead we got 65. A little bit of a surprise on 65, bear trend bar, but still completely above the moving average. Could be a vacuum test of support the way that 57 and 60 were. Look at every bear bar since pretty much here. 37, bear bar, and it was immediately bought. Bear bar, bad follow through. No great bear bars in here. And then in here, 53, bear bar, they bought it. 57, big bear bar, they bought it. 60, the same, and then 65. When you see this pattern repeating, it's probably unwise to bet that 65 will finally be the one that will lead to lower prices. Still, bears will argue it's a wedge, top, final flag, and end of the bull rally, and then we come down. I think the best case for the bears is the 57 close, and if anything, we'll create a trading range. But that's if they can even get down there. For the bulls, they might see 65 as an opportunity to buy cheaper. And once again on 66, the same thing continued. Bulls bought the close. 66, reversing up. Another inside bar, so probably buyers below, but I would not sell above. 67, follow through for the bulls, not ideal, but as far as selling below 67, I think more likely traders buying below. It's a bull channel. Traders are buying below bars and taking profits above. So 67, breaking out above bars to the left, but pulling back. So not ideal for the bulls. We have a spike in channel. And then the most likely, the way the market cycle operates, you get a spike, pullback, channel, and then the market evolves into a trading range. But the selling pressure here is weak, and most bars, we've had one close below the moving average since 47. All these bars, except for 57, are closing above the moving average. When you think about day structure and the overall context on the higher time frames, you know the market's in a trading range. So is it more likely we are in a trading range here and then we sell off for the end of the day and the bar closes a strong bear trend bar on the daily chart? Or is it a reversal day and we got to sell off for the first half of the day, get a midday reversal, and then rally higher? I don't know, it might be more likely we get that end of day reversal. 68, inside bar. So it reduces the probability for the breakout, probably buyers below, and there might be more sellers above, but I think dangerous to be selling because we're still always in long, and the market's not clearly in a trading range. The market's in a bull channel. 69, bull breakout and pullback. Could not close above 68, but as far as selling below 69, I would not. Really nothing to sell here. 70, an inside bar. Once again, probably buyers below. I would not sell above. There's that increased risk that we break out to the upside. The bears have been trying to create a wedge, and there's been a lot of attempts, a lot of tests of the channel line, and a lot of failures by the bears. And so the bulls might take a crack at it and go for the breakout, and we could go for a measured move based on the height, which could be this. And we go here and test around the low of bar 9, somewhere around this area where bulls got trapped before. But the point I'm making is that the selling pressure is not very strong, and we could get the upside breakout. 71, bulls trying to get the breakout, 3 consecutive bull bars, probably going to get a second leg. 72, minor reversal inside bar, probably buyers below. 73, almost outside up. High 1, and you could argue it's late in a channel, so not ideal to be buying 73, but also nothing to sell. 74, big bear bar. Trading below 73, but testing the moving average. And when you think about all these bars, the bear bars in this channel testing the moving average, when the market's in a bull channel, the bulls are going to buy sell-offs. And 74 is 2 legs down. We were up here, we went down on 72, 73, pulled back on 73, and then on a smaller time frame, it might be more clearly a second leg trap. So it might be more buyers below and buyers on the close of 74. And then 75, disappointed bears. So low 1 short below 75, but low on the bull trend line in the bull channel, probably buyers below. Breakout bar 76. Bears hoping we get a double top with 72 on the next bar, 77, but 76 was strong enough. Probably get a second leg. And then more follow through on 77, so not a good sell signal bar, probably going at least a little higher. And then a buy vacuum, 78, late in the day, so really not much to do here. If anything, if you're long, probably take profits on 78. It's kind of like a gift. And testing magnets to the left where bulls got trapped earlier. You have the bar 12 low, where if a bull bought, they got trapped, and we're getting close to that price. And then bad follow through 79. Only a couple bars left in the day. Probably go a little higher, but so late in the day, it's not really worth doing much of anything. And then weak follow through 79. If bulls are long, they may just exit. And then sideways to up into the close there. For always in today, because of the rally on Friday, I don't think it was clearly always in short today until bar 16. And then all through here, I think it was still always in short. Once you get 38, probably get out of shorts, and it didn't become always in long on 38, but I think it's a respectable bar. And the same goes for 46, and I don't think it became always in long until 48 or 49. But I think by 49 it was always in long, and of course never flipped always in short for the rest of the day. For stop orders today, I thought bar 3 was a reasonable short micro double top, far from the moving average, probably going lower. And then bar 4 being an inside bar, so still sellers below bar 3, still a reasonable stop order trade. Bar 12 was a second reversal down. Well, actually, let me mention bar 9. Bar 6 was the first reversal up, and it failed. And then bar 9 was a stronger bar, so you might have bulls buying above 9. But when bar 10 is a weak entry bar, it's a small bar in the middle of a trading range, you'll have bulls give up on that trade. And then we triggered the sell below 10, so that's a first reversal down. And then bar 12, a second reversal. Weak signal bar, so you need a good entry bar to make up for it. 13 may have been good enough. And if you did sell 12, you had no reason to exit until maybe bar 20. Bar 23 was, some traders might call it a low 3 short. I thought that was a reasonable short with a wide stop. And then through here, obviously really tight, and it was breakout mode. It was a triangle, possible final flag. Maybe sellers below bar 32, betting on the bear breakout, but tail below, hard to do. And then 33 might be sell the close, but 3 consecutive sell climaxes, so the downside may be limited. I wouldn't buy above 38, but like I said, reasonable to exit shorts above it. And then I thought 46 was a more reasonable bar to buy after 3 pushes down and 3 major legs down. In the day structure, possible reversal day. So buyers above 46, thought that was reasonable. And then above 48, buy the close 49, up until 51. High 154, I thought that was a reasonable buy. And 58, thought that was reasonable. And then every bull bar in here, it's always in long. You can buy above any bull bar closing above its midpoint or closing near its high. And then for limit orders today, I thought there were sellers above bar 2. Maybe not directly above, but like I said, we might have gone above bar 1. In this case, we tested it to the tick. And then bar 6, probably sellers above bar 6. Big bar, big risk, and far from the moving average, so bad context. And then almost an inside bar on bar 8 in a sideways market. After this rally from 6 to 7, that would probably get a second leg, so buyers below 8. And then through here, sellers above, but micro channel, they didn't come in until here. Sellers above 19, scaling in higher. And then all through here, limit order market, sellers above bars, buyers below bars, until they get trapped here, 33. The bulls got trapped. Here, I thought buyers below 38, strong enough bar not to buy above, but that bulls would come in below it, and they did on 41. And then maybe buyers below 41, but hard to do when it's 4 consecutive bars down. And then through here, micro channel, the first reversal down, would probably be minor, so buyers below 52. And then bull channel, buyers below any bar. And buyers on the close of sell-offs, like any bear trend bar in here. As always, please feel free to leave questions in the comments and include timestamps for any question specific to this video. And with that, I hope everyone has a good rest of their night. Thanks for watching.